Hello and welcome to this interactive investor webinar. Today we are going to be talking, possibly arguing actually, about whether you should or shouldn't invest in China. I've got a hugely exciting expert panel for you to discuss this. Some are keen on China, some are very definitely not. On my left I have Jason Pidcock, who is fund manager at Jupiter, manager of the Asian Income Fund there. And we'll find out which side you're on, but it's going to be quite obvious when we get there, isn't it?
I think so.
I think so. Then we have Victoria Scholar, who is the head of investment at Interactive Investor, and I don't actually know where you stand on this one, so excitement's to come. And over here we have Ewan Markson Brown, who is a fund manager at Crux, the managing the Asia ex-Japan fund there. Right, you can ask questions. I hope you will ask questions. You can do this on Slido. You should be able to see a QR code that allows you to access the Q&A area, so please do that. I know you will have questions, and we'll leave about 20-25 minutes, well maybe 20, at the end to try and get all your questions answered. We actually have quite a lot coming in already. The other thing I would say is that if you go on Twitter, under my name, Merryn SW, I've put up a poll asking you if you would or wouldn't invest in China, and so far it's going very much on the wouldn't, so we're going to, well not all of us, but some of us are going to try and persuade you otherwise and see if we can push the dial on that. So do please go to my Twitter account and vote so we know who is winning by the end of this hour. Right, let's start with a bit of scene setting. Victoria, can I go to you first and ask you to tell us a little bit about how China looks since its surprise reopening? You know, we weren't expecting China to come out of lockdown quite so quickly, were we? And then suddenly it did. So what's happened since then?
Yeah, that's right. It's an $18 trillion economy and hugely important in terms of global trade flows. Like you say, it emerged from COVID rather unexpectedly, a lot later than most other countries. It was pursuing this very strict zero tolerance to COVID approach, which hampered its economy last year. It had rather slow growth last year, sharply below its official target of 5.5%. I think it was around 3%. And so this year, the Chinese are targeting growth of just 5%, which is the lowest growth in a very long time. And this is essentially because it wants to try and outpace that low estimate and try and reinvigorate some confidence towards China. Obviously, not long ago, it had a huge debt-fueled property crisis, which led to the collapse of Evergrande, one of its biggest property companies, and that had big ramifications across its economy. Last year, those lockdowns really hurt its economy as well. Right now, we're looking at the release of pent-up demand from consumers who are desperate to get back to restaurants and bars and shops and travelling, like we saw here in the UK and in the US and Europe in 2021. And that's been reflected in terms of a big ramp up in terms of its equity markets since late October, although we've started to see those gains peter off over the last month, and it looks as though its road out of recovery isn't so smooth. There are some bumps in the road, and it's going to be a tough climb ahead.
Okay, so let's keep talking, before we move on to talking about the markets, let's keep talking about the Chinese economy and how that's looking. Ewan, you're looking for fairly impressive GDP growth from China over the next 4 or 5 years, aren't you?
Yeah, so maybe to take a step back and that big picture, and why do I like China?
Yeah.
And yes, it's a big economy, yes, there's lots of people, and yes, I do believe that they can deliver about 6 to 8% nominal GDP growth for the next 3, 5, probably even 10 years into the future. But why I'm really excited is that China is at the epicenter of these huge technological changes which are affecting the world over the next decade, and also the last decade. And so the last decade, the smartphone was invented in the US, and then we have the e-commerce boom, we have the social media boom, and China was a rapid fast follower. And 10 years ago, if you invested in smartphone manufacturers and e-commerce companies and social media companies in China, you were compounding your money at 20-25%. Fantastic returns. Today, the new cycle has just started. We've got a new product cycle, and it's actually once in a 100-year transition from going from ICE automotives to electric vehicles to autonomous driving. And China is at the epicenter of this, and it's leading it. And this is the first time the economy, or Chinese economy, will actually lead a product cycle. And we're seeing this in the 27% penetration of electric vehicles in China today, rapidly growing, lowest cost leadership, technological leadership. So take that to one side. We're also seeing this in renewables. They are investing more in renewable energy than all the other countries in the world combined today. So there's a lot of factors in what I call fantastic growth industries, which China is not only dominant in, has fantastic private sector companies which are compounding their earnings rapidly. So that really big picture, I think that China's economy, it's fine. It's not going to go back to the...
Can I interrupt you already?
Yeah.
Sorry. But this is a very different global environment to the last 10 years. So when you talk about the great technological successes of China over the last decade or so, this has been during a time of very open economies, of globalization and of Chimerica. You know, that was Neil Ferguson's phrase, wasn't it? Chimerica, where China and America are sort of intimately connected and very keen on being connected. And now we have a very different environment. I mean, we keep talking about it as a new Cold War, right? Where China and America are quite keen not to be connected, and we had the Inflation Reduction Act, which is of course nothing of the sort, and we have protectionism building in, and President Biden making extremely clear that he wants the epicenter of these industries to not be in China, but to be well outside China. Doesn't that make quite a difference to your ideas?
So there's the wish of politicians and there's reality. And I think everyone's eventually going to be pragmatic. You know, we've got China 16% of world exports and rising. Where are you going to replace it from? It's not just the scale of the manpower and the educated workforce, not the scale of the country. They've got first world infrastructure in an emerging country. No other country in the world has first world infrastructure at that scale and size. You can't put it into India, you can't put it into Vietnam. You know, 1% of China can move into Vietnam. Okay, you can put it back to the US. The US doesn't have the manpower, we've already seen that. It's really difficult to find other places which can take the manufacturing capacity of China. And as we can see, solar, wind, EVs, China's leading.
Does China really have the manpower? I mean, it has this demographic problem that I'm sure we're going to come on to, and it has, you know, we've seen labour costs rising in China as well as everywhere else. Does it really have this endless supply of labour that it had maybe in 2001?
Let's look at the educated workforce. Lost the numbers at the top of my head, but it's still multiples of the US, it's multiples of India, multiples of Vietnam. Yes, we're going to see huge amounts of automation. And I think the next stage of China moving up that value chain is automation. And we can already see there's a number of robots per 10,000 people. There's on that curve upwards, closing on Korea. Soon will overtake the US in the next decade. So I think that's how the overall economy changes. And yes, we're already seeing it. That low-end, labour-intensive manufacturing is moving out. So textiles, for example, already going to Vietnam, going to India, going to Indonesia. But what's growing? Autos has been the largest growth sector. And who would have thought 10 years ago that China would now be the second largest exporter of autos in the world after Germany? No one. And probably within the next 3 years, they're going to overtake Japan, becoming the largest exporter of autos in the world. And you've already probably bought them because they're currently produced under EU brand names. I reckon in the next 5 to 10 years, you're going to be buying Chinese brand autos. So again, many industries.
That's something that consumers will want. If we are moving into a new Cold War period, might you get consumers just saying, I don't actually want to buy something with a Chinese brand on it? I only ask because I spoke to someone yesterday who said that they were buying some new white goods and were absolutely determined there were no Chinese components in them, which was putting him in a very difficult position.
I think the question is, are we moving into a Cold War period, or is this mostly driven by media hype and fear? And actually, there's a way forward. And I throw this out because we can see what the US is doing. We know we've got Putin over here, and we know that Xi wants to push China to have a greater say in world affairs. But neither China nor the US can split without destroying both economies, creating massive inflation for all of us, making us all poorer. And tech chains, it's a classic example where R&D on chips, it's divided by every single chip sold. If you cut out 40% of your global market, the price of, we won't be able to do R&D, we won't be able to move forward with Moore's Law if we're not careful. So there's so many factors that I think that, and you can see it in the numbers, that exports to the US from China, all-time high this year. No deglobalization's happening. Cattle, Longi, all investing in the US. So yeah, will Chinese companies invest more in the US? Yes. Will they produce manufacturing in the US? Will they JV? Yes. Are there going to be restrictions on certain imports? I think so. In 10 years' time, are we all going to get along? Yeah.
Man who believes in rational politicians. Jason, I'm assuming that, well, I'm going to assume that you'll agree with quite a lot of that in terms of the ability of China to grow, the high level of its technological industries, its auto manufacturing, etc. Tell me if I'm wrong, but that doesn't necessarily mean you'd want to be invested in that.
What matters is profitability and return on investment. Sure, China's constantly has capex booms and it moves from sector to sector as it becomes more competitive versus other countries. But I suspect that the auto industry is going to be a very low profit industry over the next couple of decades, because I think there's too much capex going into it, and return on equity, return on investment will be low, will be too low. Return on capital, because there's too much capital going in. I think in some high-tech areas of the technology sector there will be a bipolar world, and China will have its standards, the rest of the world led by the US will have its standards. That will make it harder. In terms of direct investment, we're definitely seeing companies shy away from China, and at least at the margin want to invest more elsewhere. So whilst China for the last 20 years has been described as the manufacturing workshop of the world, I'm not sure that any other one country will replace it. Ewan's certainly right in that respect. There is no one single alternative, but we're seeing a lot of contract manufacturers shift capacity to India, to Vietnam, to North America.
Africa?
Not yet Africa, maybe one day. But I think Africa will see earlier drivers of growth. I mean, commodities for some time. There'll be other areas, and it may well leapfrog other parts of the world in some areas, but as a big manufacturing destination, I don't think anytime soon.
Don't let me distract you from China.
No. So my base case is investing always involves risk, but there's no need to take unnecessary risk. And I see investing directly in China as simply too risky right now, when there are some terrific alternatives elsewhere in Asia that give you access to their domestic markets, the region as a whole, and the global economy. And we have plenty of companies that sell to China, but because they're domiciled elsewhere and therefore not subject or not as much as at risk from Chinese regulations changing, sanctions being brought in, or investment restrictions being put in place, that the risks are lower.
Okay, well, let's talk specifically about the risks in China then. These are profitability risk. I don't think these companies will be profitable, but also we're really talking about political risk, aren't we? The idea that you think you own shares in a company, but you don't really own them because the state has more control over them than you'd like, and that there comes a point when you may not be able to take your money out anyway.
It's a genuine risk. So in America there's a list of stocks that American investors are not allowed to invest in, and American banks are not allowed to facilitate the trading in, and that includes all the listed telecom companies and quite a number of tech companies. That list is only going up, and of course the mere existence of that list means that American institutions are going to be more wary about investing money in other sectors in China, and it's a signal to the rest of the world that, well, if American investors rush for the door, do we want to be there in the first place? And then domestically, there are political risks. China has insisted on taking golden shares in companies like Tencent and Alibaba. You now have political committees established in private sector companies, and it just slows things down. It puts grit in the wheels. It reduces efficiency, and it makes you think, well, there are conflicts of interest here, and maximising shareholder return isn't necessarily going to be the number one aim.
Interesting. Do you worry about those political risks?
Yes and no. China's, the West, the state exists to help the private markets and capital markets. In China, private markets exist to help the state. And that creates a very different dynamic as an investor. It also creates a dynamic whereby we all know the state cannot increase incomes, it cannot drive economic growth, it cannot create prosperity. And the Chinese government and CCP understand that, and for the last 40 odd years, since Deng Xiaoping, they've opened up and embraced the private sector. And Xi Jinping is very clear, capitalists are patriots as well. And what's that really mean? That means is that there's times when the private sector has to be co-opted and given very high returns on capital to invest in China, and they make supernormal returns. And when that cycle then ends and they've done their job, yeah, the state does come in. And we've just had one of those for the last decade, whereby in the e-commerce and the smartphone sector, we've had supernormal returns, and then the states come in, and very much like in developed markets, where the social contract starts to be broken, there's regulations start coming in, and we're seeing it in the US, in the social media companies, questions. China does the same thing. It just does it in a different way because it's Chinese. And that comes back to my point now, is that China needs the private sector because the economy is on its knees, youth unemployment's 18, 19%, they've got this trade war with the US, they need the private sector to create jobs, create economic growth, and innovate. And I think today, given the very cheap valuations in absolute terms and relative terms in China over the last 20 years, this is a great time to buy great private sector companies, because in the next 3, 5, 7 years, they're going to be once again allowed to make supernormal returns on capital.
Let's come back to cheap in a minute. But so when you think about investing in China at the moment, are you thinking about doing it in different types of sectors than you have in the past? So the last 10 years, you know, Tencent, whatever, social media, et cetera, et cetera. But there's a definite shift in China to being more supportive of the manufacturing companies and trying to bring that into play, which you can see from who gets invited where and when and that kind of thing, right? So definitely a refocus on manufacturing. So is that where you would be shifting your portfolio?
Yes, so it's just on that. We saw manufacturing decline as a percentage of GDP for about 20 odd years, and I think it was about 5 years ago, Xi Jinping put a stop to that and said we actually want it constant. We don't want it falling any longer. And that's actually where the current large companies started to grow rapidly. So yeah, you do get state funding that. So yes, we like manufacturing companies like CATL, which is the largest battery producer in the world. We like some of the automotive companies. We like Milky Way, which is a chemical logistics industrial company. All private sector. So if I look at the big picture, do you want to own state-owned enterprises? No, I agree with Jason. These are low-returning businesses which go through cycles. Do you want to own private sector companies with a huge open, let's call it a blue ocean in front of it? Yes. Do you particularly want to own an Alibaba where e-commerce penetration's kind of done its thing, it's losing market share? Well, probably no, but then it's an ex-growth company. So really, and out of all the markets in Asia, China is the market where you want to be a stock picker, where you want to really pick your growth companies, and you want to run them until they start affecting social stability, in which case, like with the education companies, where it wasn't that private education's bad, it was that lots of companies were frauds, a lot of them were taking money from parents, offering them an education, and then effectively acting like Ponzi schemes. It was creating social stability. So there's far more nuances than the big picture. China's bad, can't predict regulation.
I want to come back to valuations in a minute, but Victoria, can I ask you before we come back to Chinese valuations in particular, do you see a shift in interactive investor clients shifting from sort of growth-orientated investments towards value-orientated investments? Is that shift happening where they might think to themselves, what I really want now is cheap stuff?
Well, it's interesting because what we tend to see when times get a bit tougher is actually a shift away from active towards more passive investments. So we still see demand for both growth and value, but we see people sort of shying away from some of the more difficult decisions. So we've seen a rise in popularity of products like ETFs and investment trusts. It's a really tough time to be a stock picker. So for a lot of our customers, we find that they prefer some more passive products. Another trend that we have seen is more interest in terms of global stocks. So previously, last year, we had quite a strong interest in the UK market, but that's really expanded more globally into the United States and further afield as well. But then in terms of the single stock pickers, we continue to see the major FTSE 100 heavyweights really outperforming, like Lloyd's and Barclays. And of course, there have been a few China-sensitive stocks on the FTSE 100 that have really benefited from this economic reopening since October. I think Burberry is one that's been a major outperformer. So there are ways to play the China theme, but while still sticking to UK equities, if that's something that people are interested in.
Okay, well, let's look at price then. How cheap would China have to be, Jason? How cheap would some of the big companies we've been talking about have to be for you to say, actually, all the risk is priced in here? I'm going to buy this stuff because, you know, I'm a value-orientated fund manager.
It's very
Maybe
difficult.
you're not.
Very difficult question. And we don't describe ourselves as value or growth. We're absolutely looking for a combination of the two. Now, there is some correlation, of course, between valuations in China and the rest of the region. So if China got extremely cheap for a reason, something that maybe we can't predict today because we haven't got a pair of magic binoculars, then the other stocks in the region would also be better value, and probably we'd still rather stick with those. So I just don't feel any urge to buy China anytime soon.
We're just not going to get them over the edge here, are we? Not going to happen.
What we look for is companies with strong balance sheets, companies that have an avenue to grow their dividends via growing earnings, companies where corporate governance is very good. We like companies that are very liquid, so we're large cap investors. And we do have a preference for more developed markets because we don't see a need to take unnecessary risks. The best performing equity market in the world since 1900 has actually been Australia, just eclipsed the US very slightly.
That's extraordinary. I bet no one would know that if you just asked any investor
They
whether
probably
Australia or the US had outperformed most.
I began investing in Asia in 1993. If you look at markets since the end of 1993 and you take the Hang Seng China Enterprises Index as a proxy for China, Australia has outperformed China by 1,200% since 1993. Now you might say, okay, that's 30 years, that's too long a period. What about more recently? Well, since the end of 2018, Australia has outperformed China by 75%. Since the end of 2020, it's outperformed by 45%. Australia is a better place to invest. It's a land with professionally managed private companies. It doesn't have any SOEs to speak of. It's got better demographics than Australia. It's actually got a fairly... Than China. Thank you. Good thing you corrected me because we are live.
We are live. That's what I'm here for. It's literally my only job.
So it's a fairly balanced economy. It's not as dependent on raw materials as some people think. And for us, it's like a small version of the US, and it performs very similarly to the US over periods. So we like Australia, we like India. So it's not that we're anti all developing markets.
And let's go back a little bit. After all that outperformance, are Australian equities still cheap enough to buy?
Yeah.
Because you look at the US, right? It's hard to find anything there that a rational investor would want to buy at the price.
I'm sure there are a few stocks in the US.
I'm sure you're right. But generally speaking, is Australia still significantly cheaper than the US?
Yes, it's our biggest overweight. We find a lot of stocks there with PEs in their teens, where we think the avenue to growth is attractive, where the balance sheets are strong, where they've got good dividend yields. So we like Australia's our biggest overweight. Okay. The other key countries are India, Taiwan, Singapore, and South Korea.
All right, I want to come back to India because we're getting some questions, but everyone wants to say something. Right, Victoria, you go first.
I was just wanted to ask you a question, if that's okay. Yeah. Just because I was thinking about thinking about how a lot of our customers are interested a bit more in the passive side of investing rather than the active side, given the sort of age of uncertainty that we're going through this year. When you're talking about the Australian market, is that still attractive from a sort of index passive point of view, or is it more a kind of stock picking market within Australia? And if so, where would you see the opportunities?
Well, thanks for that question. It's definitely a stock picker's market.
What did you think the answer was going to be?
I'm not going to encourage anyone to go passive. And look, we're very pleased with our performance numbers. There are plenty of active funds out there that can and do outperform benchmarks. I can completely understand why some people, when they're feeling more cautious, like to go a bit passive, but we think there are plenty of opportunities if you pick the right stocks. And we've got a 30 stock portfolio in total, so it is quite concentrated. We absolutely are stock pickers, but we're top-down stock pickers. And our Australian mini portfolio has done well, as has our Indian and other portfolios.
Nice.
Okay, Ewan, can I come to you? But you mentioned your Australian stocks in their prices in their mid-teens, but that's going to sound expensive to someone who invests in China, right? What does value mean to you in the context of your Chinese equity holdings?
So the whole market's on about 10 times earnings, which I think the US is on 16. This is for 16, 17. I guess Australia's probably similar. The US, I think, forecast earnings growth is about 5% this year, and I think that's going down because of global GDP much, much lower. China's forecasting about 15% this year. Given what's going on, the reopening, slow rebounding consumption, the fact that we're at cyclically depressed lows, the probability that earnings surprise in the next 24 months to 3 years is really quite high in the Chinese economy. And you're buying, so let's take the overall market. We don't buy the overall market, but you're buying that at 20-year, just off 20-year absolute and definitely relative lows to its own history and also to global history. And within that, we think the growth shares are actually really cheap. Cattle's on forward times, 19 times earnings. On my numbers, that's even three times your money over the next 7 years in that one company alone, just because it's just globally dominant. Still a stock picker's market, but even the bad stuff looks really, really cheap and probably gives you a decent return.
Stuff can stay cheap for a long time.
It can stay cheap. So this comes back to Jason's magic binoculars, that if you really think about it, where can we predict future growth? And I think we can be fairly certain that China, just because at $12,000 per capita income, still has a very long runway of just catching up in productivity. And that gives that 6 to 8% growth rate. And then if you believe that I do, that they are leading these new product cycles, and it's these new product cycles which it's all about technology, it's all about AI and the digital economy, the electric vehicles, autonomous vehicles. China's got world-leading companies, and they're going to deliver the earnings growth because they'll deliver it in China first and then go globally. So as a stock picker, it's a fantastic market. I'm not saying that Australia, you can't pick fantastic companies as well, but if you get it right in China today, given the relative valuations and relative stage where the economy is, I think you'll make supernormal returns.
Okay. There's one thing we haven't talked about that we sort of glided over just now, which is demographics in China. And I know this is one of your serious concerns about China. And there was one stunning statistic in something I was reading by you, that the population of China is going to, no, this can't be right, going to halve by the end of the century. Did I read that in something you wrote?
I'm not
It
sure.
can't possibly be
I'm
true.
not sure I said that, but it may well do if recent trends continue. So the birth rate has been collapsing, as it has in a lot of countries, but it was already very low in China.
Yeah.
So the number of people entering the workforce each year is shrinking, and the shrinkage will accelerate. Despite that, youth unemployment is in the high teens, which makes you wonder.
Makes you wonder what?
Well, why is youth unemployment so high when there are fewer young people joining the workforce each year? You'd think there would be a shortage of younger workers.
As there appears to be everywhere else.
Yes,
Yeah.
but there isn't in China.
So what's going on there then?
Well, there aren't enough opportunities for them. The economy is not efficient enough to employ all these young people, even though they're industrious and many of them are well qualified.
I was going to say, I think that's pretty much COVID and the clampdowns of the government in the last 2 years. So one would hope that this unemployed labour force goes back to be employed in the next 2 years, and that's going to drive growth. So when that 20% of unemployed goes back to its historical 5% or below, that's really the upside that we're sort of looking for in terms of the economy and then earnings growth.
But maybe their COVID policy was a policy error, and maybe there'll be other policy errors in the future.
It clearly was a policy error, and President Xi changed it overnight very dramatically.
It took him a long time to figure out it was an error, though, didn't it?
It took us a pretty long time as well, didn't it?
It did. Not quite that long, but a long
Yeah.
time, yeah.
So, by contrast, Australia's population is one of the fastest growing in the world. In percentage terms, it's growing faster than India. And a lot of that growth is from skilled and or wealthy immigrants. So people who can turn up, and as soon as they enter the country, they start contributing positively to the economy. So you don't have to wait 20 years from someone being born to be a contributor. And that gives Australia a big boost, and is why it's fairly consistently one of the highest growing developed countries in the world. So we see a wonderful combination of a developed country which is a fully functioning democracy with an independent rule of law, but it has extra growth drivers that a lot of other developed countries don't have.
Okay. Just a reminder that you should be sending in your questions on Slido. We'll be starting with questions in, I don't know, 10 minutes or so. So do that. One question I know that we're going to get when we start looking at the questions is about the ESG issues in China. You know, an awful lot of people will now take these into consideration, environmental, social and governance ideas before they want to invest in anything. Is that a problem for you?
So
Ewan?
maybe start with governance side.
Yeah, definitely start with the governance side.
20 years ago, I went to an A-share company. I think it was the Pearl Tower, which is in Shanghai, and it's fantastic China. It's a good tourist resort. And you know, I was met by the secretary of board, and the first question was like, "Why is this foreigner here?" And then it's like I started asking about numbers and ROE, return on equity. No clue. Didn't understand that they even had a share price. Today, most people speak English, all the reports are English. And most importantly, China's put their own stewardship code. And it might be a bit brutal from our point of view, but directors, if they start misallocating funds, if the companies are fraud, are going to start going to jail and probably disappearing. So what I've been really surprised about in this tightening cycle is normally you get a whole bunch of frauds and they tend to be Chinese.
Yeah. We
haven't really seen that. You know, there might be a few microcaps, but where's the big fraud out of China this tightening cycle? There isn't one. And I think generally they've really cleaned up their act on the government side. Now there's always bad apples, but I actually think they're far more equal versus the West and the problems we're seeing in the West. And even if you talk about the banking system, the stability of the Chinese banking system versus a Western banking system, you know, if I was President Xi, I'd be looking, well, I'm glad I didn't give free money to everyone and cut interest rates to zero, because look where it gets you. Environmental. Big picture, China, as I said earlier, is investing more in energy transition than the rest of the world combined. Now it's still burns more coal than most, well, every other country in the world.
Every other country put together, I think.
Probably. And it's going to take time. And yes, the skies are cleaner in Beijing than they were 5, 6, 7 years ago, but they're still pretty awful. But I can bet you in 20 years' time, they're going to be pretty clean, because 90% of cars are going to be electric. And those coal power stations are either going to be back in the middle of nowhere, and some of them will, or there's going to be wind, solar, nuclear power. And that transition is going to happen far more rapidly than us sitting here can ever imagine. And the EV thing, I think we'll hit 70–80% EV penetration within 4 or 5 years. And then autonomous vehicles, and then solar. And then there's obviously the social side. And this, I guess, it's the hardest. If we take a bigger picture, we obviously got Xinjiang province. It's obviously an authoritarian country. And you go, well, what are we, you know, in a world where there isn't black and white, there's lots and lots of greys, and we deal with Saudi Arabia, we do lots of places in the world which, yeah, not great. Is it better to trade with people or to shut your borders and build walls? And if you're trading, you're far less likely to have wars, you're far more likely to have common ground, and far more likely to actually have peaceful coexistence and grow and be wealthy together. And maybe even then you can convince them that this side's probably better.
Europe was trading big time with Russia. It bought most of its gas from Russia and didn't stop Russia invading Ukraine.
Putin made a classic mistake. He bought a stock thinking that he could take Ukraine overnight. It failed, and rather than selling out and going back to his hole, he decided to double down and change his story.
It's basically a really bad investment.
It's a really bad investment. But that's, you know.
Are you worried about the more and more close ties between Russia and China economically and diplomatically, given that we've just had this 3-day summit and that China has supported Russia at a time when the West has essentially shunned its economy in light of its invasion of Ukraine?
Yes. It'd be
hard to say no to that one, wouldn't it?
Silly to say otherwise. You know, if the biggest picture that keeps me up at night is the geopolitics. If it wasn't for that,
specifically between Russia and China?
Specifically Russian. I think if a Russian war wasn't there, the US action would have already faded into the distance. It's the fact that Russia is there, and that makes everyone rightfully quite nervous and upset. And China, it's not actively supporting, but it's pretty close. I'm fairly certain that the Chinese people, the bureaucracy, and Xi Jinping himself was caught by surprise by Putin. And that's left them in a very awkward position. Putin would love to garner world support. And we've just seen the peace deal in the Middle East between Saudi and Iran, which America basically let China do. Everyone was massively surprised that China managed to get a peace deal. And it's part of the reason why the oil price is going down, because we're going to get Iranian oil, and it's actually been quite good. Can they do the same thing in the Ukraine? Well, probably not today, but I wouldn't be surprised in 6 to 9 months' time that a China's brokered peace deal might be on the cards.
So we could see China being behind an outbreak of global peace.
It would be ironic, wouldn't it?
It would be unexpected.
Unexpected.
And it would ruin the whole Cold War narrative.
Yeah, but isn't that where you really make money as an equity investor? Finding those unexpected outcomes, low probability, but really quite insightful?
Mm-hmm. I mean, nearly there?
Well,
nearly there?
We prefer to back the tortoise than the hare. We like some of the companies we invest in might be considered boring, but they do what they do year after year after year, and they deliver good returns. When it comes to ESG, we're not a fan of China for this reason. It is a hardline communist dictatorship. It doesn't have an independent judiciary, so it doesn't have the same kind of rule of law that we have and that we enjoy. The Communist Party can change any law at any time they like, and nobody can appeal against that. So it is a risk that you have to take into account. Now, as Ewan said, the economy, A, it's currently rebounding, and B, it will grow over the next few years, but we have plenty of companies based elsewhere in the region that can sell into that growth. So we can play the rebound in China's tourism by companies that sell to Chinese tourists. We can play the rebound in demand for certain commodities via certain mining companies. And on the tech side, Hon Hai, the largest contract manufacturer in the world, big investors in China, but they are at the margin shifting capacity elsewhere. They will benefit from a growth in demand wherever it may come from.
Tell us about some of the other companies that you're invested in then that have this exposure to China. Who are you investing in to take advantage of the return of the Chinese tourist?
So Genting Singapore, which manages an integrated resort in Singapore, which does include a casino, but they've also got other forms of entertainment, and a lot of the Chinese tourists who leave mainland China, when they go beyond Hong Kong and Macau, a lot of them do like to go to Singapore, and it's one of only 2 casino operators there. We have Thai Beverage, which is the biggest beverage company in Thailand. It sells spirits and beer there, but also in Vietnam. ST Engineering is the world's largest maintenance company for aircraft. So the more planes there are in that region, the more planes need to be serviced, and when they come to the end of their natural life, they're converted from passenger to freight planes. They benefit.
Hang on, not safe enough for passengers, but safe enough for freight.
Well, when they come to the end of their natural life, well, yeah, but no, it's not a question of safety. It's
comfort,
wear and tear.
Okay.
And yeah, we have mining companies, we have energy companies, we have tech companies.
And are the mining companies Australia based?
Yes, all of them. So BHP, the world's largest mining company, sells plenty of iron ore to China, and iron ore demand has picked up in recent months. We have Mineral Resources, which is involved in lithium and iron ore and mining services, and we have Newcrest Mining, which is a gold miner predominantly, but also mines copper and sells that, and that was recently bid for by Newmont of the US. We don't know how that will pan out, but it validated our investment case by the fact that Newmont found it so attractive. So we only have mining companies in Australia.
Why only in Australia? Is that an ESG consideration?
Partly, Partly, we do. We think governance is better. We think that the way that they're managed, we feel more comfortable with it. And in other markets, we have preferences for other sectors. There are elsewhere we'd rather invest in other businesses, whereas mining is something that Australia does do very well.
Okay. I think, Ewan, I should let you talk about some of your favourite companies in China.
Okay. Well, let's pick Li Auto. This is one of the new NEV models, so leading in electric vehicles. It's a startup about 4 years ago. What really attracts me to this is that they're partway through a transition, so they're sort of quasi-hybrid, still got an old ICE engine, but an elite EV type motor. And they're just gaining market share. They've got the right product at the right price, delivering to a Chinese consumer. So I think last December, doing 20,000 units. So they've gone from effectively not saying anything to probably 200,000 to 300,000 units this year. A new automaker coming from nowhere. And what I think people misunderstand about the current cycle is that autos are no longer a mechanical product, they're now a technological product. And the same thing with your smartphone, that every year it got 20% better and cheaper. Cars are now going to start getting cheaper and better, roughly by 20% forever. And that's going to change how we live, how we work. We're just talking about Li Auto's L9 having LiDAR on it. And what's that going to do? It's going to give you ADAS. It's going to be self-driving. Now it's completely level 3, level 4, so okay, it's going to be motorways, it's going to reverse park. It's not going to be going everywhere.
Okay, hang on, let's go back a bit. How soon until I can buy a car that's going to parallel park outside my house?
I think you'll be able to do it
without me touching anything. No risk of me driving into a lamppost or anything like that. Actually going to park my car for me.
You should be able to do it in the next 24 months.
And will it be Chinese?
Or it could be a Tesla.
Could be a Tesla.
But the technology is there today, it's just whether it's going to be mass produced or not. And it's whether the cost. And this comes back to the cost down. I'm seeing numbers, you can see all the forecasts. They take current costs and go, well, no one's going to pay $100,000 to have a self-driving car. It's not going to happen. But the Chinese, and we've seen it with smartphones, we've seen with everything the Chinese do, the cost comes down dramatically once you make it a tech product. I think we're going to see, Baidu is another stock which we like, it's the largest stock in our portfolio. They've just launched their Ernie bot, which is a chat GPT in China. But what I really like about this is their autonomous driving. They're probably number 2 in the world in miles driven. They are going to be the first to market in taxis in China. And this comes back to that population thing. We're going to see massive automation of low-end jobs in China, and taxi drivers is going to be one of them. And because China has a different set of rules to the West and a different incentive structures, I'm fairly certain this autonomous driving is going to be way ahead of where it could be in Europe and the US. Just on the taxis alone, Baidu is a $60 billion company. We think the revenue from taxis, it's not just the trip that Uber gets, it's the amount you pay for a driver, all of that goes to revenue or profit to autonomous taxi driver. So we think this could be a $1 trillion business in the next 10, 15 years.
So do you think that China will soon be exporting deflation to the rest of us again?
Yes.
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 Because a lot of the inflation dynamic, I'd be interested in your thoughts on this, Victoria. A lot of the inflation dynamic is about China no longer exporting deflation to the rest of the world, but exporting inflation, and so that whole deflationary impulse around the world disappearing. And you're saying the opposite.
That's my take. Manufacturing ramps up, that's deflationary goods hitting US shores. Autos, we've had people raising car prices. That's going the opposite way. You've seen what Tesla's done. You've seen old auto OEMs like Ford, VW copy. Prices are only going one way with autos, and that's down. Now, yes, Jason said that could lead to a profit collapse, but what I think is going to happen is going to lead to a profit collapse in the original manufacturers. The tech companies are going to make good profit margins because their cost downs are falling more rapidly.
Interesting. Does that fit with your view on where global inflation is going?
Well, obviously we've seen this huge revival of inflation post-pandemic, and that's been popping up all around the world. But China's inflation rate actually is still just 1%. and we saw weakness in food prices, in particular in the latest data. And we've been seeing this sort of huge shift towards monetary tightening from key global central banks that's been much discussed over the last year. But China is actually the outlier in that, and there's been talk about whether it could carry out further stimulus. But actually, one argument why it may not is because of that interest rate differential that would exacerbate if China were to cut rates at a time when the global tide is towards tightening, and that could lead to a weakening of the Chinese yuan and also to a lot of outflows. So there's quite a bit of caution around monetary stimulus, even though it would provide a tailwind to the Chinese economy because of the implications for the currency and potential outflows.
Interesting, and we're beginning to get questions. In fact, we're getting quite a lot of questions, and quite a lot of them are about exactly this, about currency risk, about how you deal with that as an investor in China. We'll come back to other Asian markets.
So obviously China's effectively a pegged currency to the US dollar. I always see it as sort of just a US state which does mass manufacturing and consumes.
I'm sure they would love to hear that.
Love to hear
China,
that.
a US state that does mass manufacturing. Hate mail to the usual address.
Russia being a state of China.
Yeah, well, Russia's just been a part of Europe, isn't it? They can't get themselves out of this pickle. So in terms of interest rates, where was I? Currency risk in China is all about picking where the US dollar is going.
As long as you assume that peg holds.
It's held for
so long.
And the same with the Hong Kong. Every cycle, someone's either telling me it's going to go up or down, and it never does. Across Asia, we always invest understanding where earnings are going given currencies, and we're looking for US dollar return. So there's some depreciation, but with Chinese earnings move in line with US dollar. So if the US dollar is weak, you would generally expect earnings to be positive in China, more domestic. If the US dollar is strong, more on the export side, and we just adjust your portfolios accordingly. We never hedge currencies.
You never hedge currencies. That's really the core of the question.
Same for us. We don't hedge currencies.
Okay, right. I was going to ask you, Ewan, what it might be that might make you think that the political risk was just too big to be in China. And in came a question saying, if China were to provide lethal aid to Russia to prevent its critical resource partner losing it in Ukraine, would the West be morally forced to sanction China? And how would that affect your views?
That is probably the key question, which kept me up at night. So if I take you back to...
I'm glad you're not completely relaxed.
Yeah.
About
March last year.
Glad he's awake at night.
Yeah.
All fund managers should be awake at night all the time.
All the time, consistently. March last year when the Chinese market collapsed, and that was when Putin invaded, and it was is China going to back Putin and supply weapons? And they came out very clearly that they're not. And today, we just had his big meeting with Putin, and they were on a very short table, and Putin was very, very kind to Xi, but there was no forthcoming agreement outside of Chinese platitudes. I think the numbers are sort of 200 billion of sort of exports trade with Russia, 850 billion with Europe, 700 billion with America. There's nothing that Russia actually offers apart from a bit of oil and gas. There's no consumer market.
Quite a lot of oil and gas.
Lots of oil and gas.
Quite a lot.
Well, a lot.
And China's getting it pretty cheap.
But it's fantastic for them. It's fantastic for the Indians. And actually it's fantastic for everyone who's being quiet and just buying the oil and gas. You have to remember that the world's not just a few European countries and the US. The majority of the population's outside of the West. And they don't quite see it in the same way that we might do. And they're still trading Russia.
Yeah, Jason.
What was interesting, I think, when Russia invaded Ukraine, it wasn't just governments that sanctioned Russia, it was consumers. Consumers wanted to know that the companies that they were buying goods and services from were not dealing with Russia. And I think a lot of people say because we trade so much more with China, if something changed, like they invaded Taiwan or they provided weapons to Russia, that they're just too big for us to cut off. I don't think consumers would see it that way.
You think it was a harder choice for a consumer to say, well, I'm not going to have an iPhone anymore?
Well,
and our gas
It's
prices.
easier to give up vodka than iPhones. Well, for most of us.
more phones are being made outside of China. At Apple's request, their contract manufacturers are increasing capacity in other countries, and the highest end iPhones can now be made in India. Samsung Electronics make most of their phones in Korea and Vietnam. So the capacity is springing up outside of China. I'm not saying trade would drop to zero, but there would be a significant.
You think consumers would strike?
Absolutely,
yeah.
Yes.
If we were paying the full gas price, I imagine the support for this current war would be quite different. Now, obviously, the gas prices are falling now, so I think fairly said that was Putin's calculation, and the government capping it was fantastic. Coming back to the earlier question, if China actually does support Russia as clearly we go to war footing, everything changes. I'm basing where we are that pragmatism prevails, that there are certain red lines which are disastrous for Xi, disastrous for us in the West. Hyperinflation, collapse of our living standards, and probably a revolution in China if their global trade was cut off. Never say never, because we've done pretty stupid things before over the last 100 years.
It's tended to be countries that aren't democracies that have done them.
I won't go into Germany, yeah, but
I'm going to cut
Cut
that
me on
conversation right there. And say, one of the things, you've both mentioned India in the last 2 or 3 minutes, and it's one of the questions that people are asking. We've talked a lot about China, but is India a market that people should be looking at the moment?
I think this is probably something we can agree on.
That's where I was trying to head. I want to
Diplomacy.
finish this hour in a happy, harmonious place.
So India is the second largest weighting in our portfolio. So we have just over 50% of our fund is in Australia and India taken together. So we've got the best developed market in the region, the best developing market in the region. India isn't cheap, but the avenue to growth is very, very strong. And it is largely a domestic economy. It's not a particularly open economy. It's got a lot in its favour in terms of playing catch up, so GDP per capita just catching up with other countries, even just other countries in Southeast Asia, gives it quite an avenue for growth. Politically, it's better than it once was. The government is more friendly to business, wants to see a growing economy. Also, from a geopolitical point of view, everybody wants India to be their friend, and so India is sort of able to get away with things that some other countries can't, because it can keep a foot in different camps. So we've got 5 stocks in India, all in different sectors. Our largest holding in our portfolio is actually an Indian stock, ITC, which has been one of the best performing stocks in the whole of Asia in the last 18 months, been an absolute standout.
Tell us about it.
So it's a consumer staples company that amongst other things, they do sell cigarettes, and that, I think, prior to the end of 2021, that was something that was off-putting to a lot of global investors. I think during the course of last year, people changed their minds on sectors like that and others, like defence, for example, for good reasons.
Actually, you can see why people change their mind on defence, energy, etc., but I'm a bit stuck on cigarettes.
Because they outperformed so much last year.
Because of the money.
People couldn't ignore it. Cigarette companies around the world tended to outperform last year because by the end of 2021 they were very, very cheap. But ITC is in a net cash position. It's very large, it's very liquid. It generates a lot of free cash flow from its cigarette business, which it invests into other areas such as food and beverages. And in its own right, it's one of the largest 3 F&B companies in India now. It has a national distribution network, so when they make acquisitions of regional companies, they can plug those into their national distribution. It's got very good corporate governance. Within its sector, it has the highest ESG rating. And compared to other Indian stocks, it has a pretty good dividend yield and decent dividend growth. So for us...
What's a good dividend yield for India?
Well, anything above 3% in India is good. The market's currently yielding about 1.5%. Our mini portfolio on average is yielding 3%, and ITC is a little above 3%. But So, and you might say, well, that doesn't look attractive compared to the 10-year government bond yield in India. And the way that we value companies, there are two key metrics: good old-fashioned PE, which I think is simply the best, but also dividend yield compared to the risk-free rate. And for that, we take the 10-year government bond yield as a proxy, and we think, okay, how does the dividend yield compare to the 10-year government bond yield, and what dividend growth are we expecting over the next 10 years compared to a bond which of course has a fixed coupon. Now the 10-year government bond yield in India is about 7, not far off that. So the equity market, just compared to that, does look quite expensive unless you anticipate a decent amount of growth, which we do. Yes.
Can I ask, if ITC has already been one of the best performing stocks over the last 18 months, do you still think it's attractively valued now if investors wanted to look at that stock, say, today?
I do, because I think it was way too cheap 18 months ago.
Yeah.
It's not as cheap now, but I think it is still a very steady...
Still undervalued?
I do. It's a great proxy on domestic consumption in India. It is well managed. They've got these other divisions which are growing faster. It generates a lot of free cash flow. Rock solid balance sheet. It's very liquid. You don't have to worry about the kind of issues that we saw with the Adani Group. And so when that occurred, that helped ITC and other similar stocks that people thought, well, we know we can definitely trust them.
Yep.
But it's the beauty of investing in higher yielding stocks is through the course of the year they self-liquidate to a degree. And so when you stop buying them and you just take those dividends, and all else being equal, on the day they go ex-div, share price adjusts and it comes down. If you don't put more money in, you're accepting that the weighting is coming a bit lower. So our weighting today in ITC is lower than it was at its peak, and we've been investing more money into other stocks where we now think there may be even more upside.
Indian stocks.
I was going to say we like India as well, but I just love a different way that we invest. We do almost the opposite of Jason. So I'm looking for companies that can compound at 15% per annum for the next 3 to 5 years. When they go up, when my thesis is coming through, when my earnings are coming through, I'm adding to those positions and I'm running them because I believe in the compounding of that growth. A great example for us at the moment is KPIT in India, and it's probably a name you've never heard of. They, we believe, are the world's leading outsourcing partner for auto manufacturers to basically drive electric vehicles and ADAS. They're big partners of VW. They've just announced a 100 million contract with Renault and Honda. Fantastic business, free cash flow generating. We think this business grows at 30 to 40% per annum for at least 5 years, maybe even a decade. And what am I paying for it? I'm paying about 40 times forward earnings. I think it's just far, far too cheap because it just carries on compounding year after year. The multiples stay the same. And I agree with Jason, we look at P multiples, but it's really 5 years down the line where I can see this company sub 10 times earnings and it should be on 30 times. So yeah, India, great market, style of investment cycle coming up. It is expensive though, which is why today I think you're going to make more money from China.
The market isn't cheap, but of course you've got to look for the better stocks within it.
Okay, we're coming near to the end here, and we've talked about a lot of different things, but can I just ask you before we go, if you had to pick one stock from your portfolios, you're not supposed to ask fund managers this way, always do. If you had to pick one stock from your portfolios to hold on to for a decade, what do you think it would be?
Hon Hai in Taiwan. It actually does a lot of what Ewan was talking about. So it is the world's biggest manufacturer of iPhones and I think therefore smartphones, because it also makes smartphones for other people, and it is moving into EVs. So it's going to build EVs for other companies, and I think a lot of the car companies that we're currently aware of, they will concentrate on the design, the branding and the distribution, but increasingly they will outsource the manufacturing because, as Ewan just said, cars are becoming more of a tech item than they were. And this is the advantage that Hon Hai has. It's absolutely best in class in terms of supply chain management, bringing components together and assembling them. And it will, I believe, it will undercut all other car companies in the world. They think that by the end of 2025, they could be manufacturing 5% of the EVs in the world. and I wouldn't put it past them given what they've done with consumer electronic products. It's large cap, net cash, high dividend yield, low PE. So for us, it ticks all the boxes.
Sounds great. You want to choose the same one?
Price deflation coming to you via Hong Hai. I'm going to go for Baidu, and you know this is your Google of China. We know search is effectively ex-growth, advertising is weak, so cyclical upside coming through, trading on about 10, 11 times earnings. What really excites me is the two parts of growth, and if I'm right on the technological change, first of all, they're going to be the leading in the chatbot, ChatGPT. Do I understand the revenue model? No. Do I think that it's going to work better in China? Yes. And that's because these things are actually going to be quite easy to do. And in the West, everyone's going to have their own model, and it's going to be who's going to build a platform on top of. In China, because it's going to be so controlled by the government, I think there's only going to be 3 or 4 players, and Baidu's going to be leading on that. And the other part is the autonomous vehicle, where they already got 250,000 miles driven in China, part of Beijing. They're already 25% of the taxi fleet. And on a 5-year view, this could be one of the most profitable business models in the world. So I'm sticking with that one.
All right, brilliant, thank you. Victoria, are you more persuaded or less persuaded towards China than you were at the beginning of this conversation?
Well, I think that actually you both probably had more in common in terms of your view than it might have initially presented itself, because I think you're still interested in China, but you just want to play it in a slightly more conservative way that doesn't give you direct exposure to China. But a lot of the themes that you were discussing in terms of the explosion of technology and the growth potential in China, I think you probably agree with.
Yes.
So although you kind of are on different sides, I actually noticed quite a few sort of overlaps.
Excellent.
That's a very diplomatic answer.
Very good.
That's why you're sitting between us.
A draw.
And actually, looking at Twitter, I have to tell you that this is really bizarre. Nothing has changed. Exactly the same percentage of people are pro
Were
and
people
anti.
watching?
Yeah, maybe no one was watching at all. No, I can see that lots of people are watching, but you know they're still in roughly the same place. So I think we will have to leave it there. But thank you, Ewan, thank you, Victoria, thank you, Jason, and we look forward to seeing you again at our next webinar.
Thank you, Merryn.